In this video, we're going to discuss the differences between the stock pricing and the options pricing model. Now, that options pricing is considered to be known as the Black-Scholes model because this is the main equation used when we determine our options pricings or our options premiums. Now, this was developed by Fisher Black, Myron Scholes, and Robert Merton. And the Black-Scholes model takes into account 5 different things. So it takes into consideration the strike price of an option, the current stock price and direction, time to expiration, risk-free interest rate, and volatility. So basically, you take all of those, combine them into one, and then that is how you get your options pricing. Now, stock prices are relatively black and white, right? So they're really simple because they already have the health and everything about that stock basically already priced in. You have a little bit of implied volatility, right? So a little bit of speculation, but the health of that overall stock is already built into that price, and you can hold these for eternity, right? So basically, until the stock gets delisted, you will always have shares of whatever stock you purchase. Options prices are the exact opposite of that because they are finite derivative, right? So you cannot hold them for eternity. They have an expiration time or a time to exercise. And within that time frame, traders decide and dictate future volatility or expected moves by betting on certain strikes they believe the current underlying may or may not hit. So the main contributing factor to this options pricing model, right? So you have the strike price of an option here, the current stock price, time to expiration, whatever contract you purchase, you only have a certain amount of days, right? So that's going to make all your theta and your gamma and everything like that increase, your vega as well. You have your risk-free interest rate here, which is rho, which doesn't really contribute that much. But the main contributing factor is going to be volatility. So stock prices, you still contain that volatility, but it's only speculation on where that the underlying will trade at, the health of the stock. You're looking at the earnings, the revenue, everything's basically already priced in. Whereas the options, we're taking speculation upon that speculation, basically taking it a step further, right? So the main contributing factor is going to be volatility. And what is implied volatility, you might ask? Well, it is a forecast of an expected or likely movement in an asset's price. So implied volatility looks towards the future price movement. Historical volatility looks hindsight, right? So it's also known as realized volatility. So you hear people talk about realized volatility, historical volatility. It means something that already happened. Hindsight's 2020, right? We already know the historical volatility of Apple stock. What we don't know is what will happen in the future because nobody knows that. So implied volatility is a deciding factor in the pricing options, as options with higher implied volatility have higher premiums. Those with low IV have lower premiums. So you have more IV, you're going to be paying more for your options or selling them at a larger price. If you have low IV, you're going to be buying them for a cheaper price or selling them for a lower price. That's all that means. So implied volatility is going to be that speculation upon other speculation, and it's going to take into consideration that expected move. So it's basically influenced by the supply and demand of the options markets, and the market's expectation of that underlying direction, right? So if all of a sudden you see a lot of people start stacking the deck one way against a certain option strike price or a point in a expiration date on a particular stock, you might know something's up. That means, hey, everybody's taking bets down here that this certain stock will decrease in value or increase in value, depending on where they're actually trying to purchase all those options at. And they're trying to take advantage of that volatility because now all of a sudden volume's kicking in, coming with it. Your volatility is expanding. That expected move is expanding, and your standard deviation is growing larger and larger. So when we're talking about implied volatility, we always have to mention standard deviation, and it's actually often shown as an annually as a 1 standard deviation percentage when you're talking about implied volatility. But for example, just to make it easy here, we have our little bell curve here, our standard deviation. It's just a calculation that measures the dispersion of data from its mean. So we're always talking about stocks reverting back to its mean, or an options price reverting back to its mean, right? Things always kind of overrun and have to come back down. That's considered consolidation, or they drop real high. Then it goes a little dead cat bounce, consolidates first, and then drops more. It's always talking, we always mention to revert back to its mean. So that's kind of what standard deviation is, you always have a bell curve. There always is a middle, right? So if you think about these as grades as kids, you're always going to have your C players in here, right? Your C kids, your A pluses are going to be here, and your Fs are going to be down here. You're always going to kind of revert back overall to these C kids in here. Now, a standard deviation basically just covers 68% of occurrences over the next 365 days. But when we're talking about options expiration prices, these are already calculated in. So we can actually easily check the delta to figure out where our standard deviation is. So a 30 delta is a half a standard deviation. 16 delta is always one standard deviation. And then a 0.25 delta, I did this wrong here. It's not 2.5, but it's basically 2.5. 0.25 is how you're going to look at it on your options chain. A delta is a 2 standard deviation. So this covers 95% of occurrences, right? So you can see here on our bell curve, our particular stock that we're looking at right here is trading at $500. So you have a 68.2% chance that the stock could either go to 520 or 480. That is going to be your one standard deviation. Below 480, you have a 15.9% chance that the stock is going to do that. Now, above 520, you have the same exact chance, 15.9%. So standard deviations are always created from that implied volatility from the options prices, which is derived from that Black-Scholes model. That is how we get that. That's how you get your standard deviation for the stock price, because it's coming from the speculation upon speculation, your implied volatility from your options prices. That's how we get that expected move for the underlying asset. Now, also with this bell curve, this can be skewed. So you can have the bell curve kind of up over here. And then you also can have the bell curve skewed this way more. So even though the stock is trading at 500, your curve could be out here more, where everybody is pricing in a larger price here to the 530s, 540s perhaps, whereas they're not really concerned with the 490s. That just means that everybody is pricing in a movement to the upside. Same with the bell curve on the downside. Everybody's pricing in a movement to the downside because that is where your risk is. Now, visually here, what are we looking at for in low implied volatility? Basically, your bell curve gets tighter, right? Because your expected move is not as much as before. So you can see that our arrows here, where our standard deviation is compared to our bell curve, really, really tight. Whereas our next slide, now all of a sudden you have high implied volatility where you have a larger move. So the dispersion of data from its current mean is going to be larger because everybody's pricing in a larger expected move. So all in all, what is our differences, main key that we're looking at between stocks and options pricings? Well, stocks variables are already built into that price, right? The health of the company, things like that. Options have external value. So stock prices have a lot of, I wouldn't say they don't have a lot of external. They have more intrinsic value than they do have extrinsic value. So I guess we'll just say it like that. So stock prices carry more intrinsic value, whereas options prices, the most of the premium that you're going to pay for carries a lot of that extrinsic value. So also options are finite. They will expire on a certain date in the future and carry the volatility. Volatility derived from the options of, from the underlying and trader speculation of a stock's movement with a certain time frame factors in the aggression of the purchasing of those contracts. Implied volatility is a forecast or an expected move of an asset's price. Higher volatility is going to bring bigger moves. Lower volatility is going to bring you lower moves. And then higher implied volatility increases the width of our delta overall relative to the strike price and vice versa, creating wider or narrow standard deviation. So again, all in all, options pricing, you're just going to do speculation on speculation, right? It's all about the implied volatility there. Where's your standard deviation? Where is everybody kind of pricing in things? Your stock prices, that standard deviation is based on the options price, but overall the price and the health of the whole overall company is already priced in there, right? So it's already built in. You can hold that for as long as you want. Options prices are going to be finite. You have to sell them at a certain date, and it's mostly extrinsic value. All right, guys. Hopefully I didn't ramble too much, and I hope that this video made sense to you guys. I tried to kind of go through it as fast as I could here. Hopefully the PowerPoint helped more rather than just kind of me rambling and pointing at things on an options chain. But if you did like this video, make sure to check us back on all of our social media. We also have a Discord service if you're interested, and you can find all of our socials in the description below.